Welcome, everyone. This is Paul Forchione, and I'm here today to present the webinar about allocating risk by using the Greeks. Now, most people, if they heard that subject, would probably wonder what the heck we're talking about, but since all of you are options traders, I'm sure that the terminology that I'm using is something that you're familiar with. Nevertheless, what I'd like to do is to start off by giving a little bit of an overview before we get into a lot of the details concerning using the Greeks when creating options positions. As a matter of fact, what's really important to understand is that as an options trader, you have a wide variety of choices to make. You have tremendous flexibility on how you put together your positions so that the risk that you are taking when you put a position on is going to be much different and much smaller than the risk a futures trader would be taking. I'm going to give you an example of what I'm talking about by showing you my option view application. I'm going to share my screen so that you should be able to see the quotes display for my options view. And by the way, for those of you that are new to the webinar process, if you do happen to have any questions or comments, feel free to put them into the chat window, type them into the chat window, and what I will do is periodically go and take a look to see what questions or comments you may have. What I've got here is a listing of approximately 38 futures markets. The symbols are shown here on the left. And what I thought I would do is start off by looking at the gold market. Symbol GC and Z3 represents the December of 2013 futures contract. So I'm going to pull up, first of all, the matrix for the gold contract. And what you're looking at now is what we have is October, December, February, April futures contracts. You can see what their prices are. They're pretty close to one another. And then we've got a whole array of options that are available to be traded. Now, if you're a futures trader, you really don't even need an options analytical program like OptionView to help you. But if you were a futures trader, and let's just say that you were to sell a December futures contract, what does that really mean? When you take a short position in a futures contract, what is happening is that you are acquiring a position that is going to benefit if the price of gold declines, if the price of gold declines. And what are we talking about? Gold futures are priced for the contract month of December at 1386.90, 1386.90. I have real-time quotes, so right now you can see the price has changed to 1387. Well, gold futures represent 100 ounces of gold. This is the price of 1 ounce, 1387. And when you multiply that by 100 ounces, because that's what a futures contract is, we're talking about an underlying contract value of $138,700 approximately for one futures contract. So as a futures trader, you are definitely going to be subject to all of the price fluctuations, favorable on the downside, unfavorable on the upside, the moment you take that short position. What happens if I click the Analyze button? Let's see here. Let's see. Let me go back into my program here, put in a short position on December gold futures. click the Analyze button, what are we looking at? We're looking at the performance graph or the graphic analysis for a short gold futures contract. And you notice there's one blue line. It doesn't matter if we have today's date, T plus 0, in the upper right corner of the screen, T plus 26, 26 days from now, or even 79 days from now, today plus 79 days. Time means nothing. Only price movement is significant to a futures trader. It doesn't matter how long it takes for the market to move, but the moment it moves, the position will either earn money on the downside or lose on the upside. Let me change the scaling to be $10 an ounce. A $10 move in gold is rather small, actually. So as a futures trader, you could see that you're going to make basically $1,000 with a $10 drop in the market, and you're going to lose $1,000 with a $10 rally in the market. Now, trading a $138,000 asset where you're that vulnerable to short-term swings is something that most people don't really feel like stomaching. Even if they put in protective stop orders, in this case it would be a protective buy stop in the event the market rallies too far and you attempt to limit your loss, there's no guarantee that you will be filled on your protective order at the buy stop price. So you do have that possibility of slippage being incurred on a fast move to the upside. So this is really where options come into play, and this is where the Greek variables come into play. The Greek variables meaning we're going to be dealing with not just price movement itself, but we're going to be dealing with the passage of time so that your options positions can either earn positive time decay to help you generate profits. They may also possibly incur negative time decay. And we're going to be dealing with changes in the premium levels of the options themselves. That's implied volatility. Implied volatility is a measure of how much a premium, how much prices of the options expand and contract on the basis of expectations that options traders have for movement in gold. So let's say that you're not going to want to put this much money at risk. It would take $10,800 of margin to take a position in the gold futures. Let's say that instead of that, you were to purchase a December at-the-money call or at-the-money put, since we're talking about being bearish. That would be purchasing a 1385 put in the month of December, which the December options expire on November 26th in 78 days. Now, underneath, on the bottom of the screen, you can see the Greek variables, delta, gamma, theta, vega. The delta of this option is minus 44, essentially minus 45. What does that mean? That is a number that you can think of as a percentage number. In this case, 45%, which means you are acquiring the equivalent of 45% of one futures contract. You are going to be subject to 45% of however much that futures contract moves. So if I click the Analyze button, and if we were to get a $10 decline in price of gold futures, this particular option today would generate a profit of approximately 45% of that $10 move. 45% of $1,000 on the futures is approximately $450. You can see it comes out to be $480 here on the P&L. Now, there's a lot of other things going on, but just in terms of pure price movement, you can get an idea of exactly how much participation you are going to have in any kind of a move. A $20 down move, you'll have essentially a $990 profit. And why is that? Well, the position started out with a 45 negative deltas. After it drops $20, it has 52 negative deltas. So you could say over that $20 move, the average of 52 and 45 is approximately 48%. You're going to participate in 48% of the move. A $20 move is $2,000 on the futures times 48% comes out to be $960 on my calculator. OptionView is showing us a $990 profit, close to the 960 figure. Likewise, you have losses on the upside. Now, there's a lot of other things happening here because you'll notice the Greek variable relates to not just price movement, delta, but also we have theta and we have vega. Theta is time decay. Because options are wasting assets that have a limited life, and in this case, the December option has only 78 days of life, every day that goes by, the option's price, the theoretical price of the option, will drop by $32.42 a day. And if we were to look forward in time to T plus 26, which I just clicked, and it made the second performance curve turn red, you can see that if the gold price is still at 1386, now the theta is minus 39.11. The negative time decay is becoming increasingly negative with the passage of time. So the time decay factor on options is not linear. It happens to be nonlinear, where the closer you get to expiration, the faster the options will tend to decay, especially when they are out of the money. Now, everything is dynamic, so that if we do have a down move in the price of gold, and we have the passage of time, 26 days, now you can see the delta is minus 53, the theta, the negative time decay, is minus 37, and you can see how the delta and the theta changes depending on what price you look at for this particular T plus 26 timeline. The other very significant factor in this case is the Greek variable called vega. And in this case, it's 208.4 at an unchanged level. That is a dollar figure, just like the theta is a dollar figure. And delta is a percentage figure. The vega factor in dollars is telling us that this 1385 December put that we purchased is affected by the tune of $208, depending upon whether implied volatility increases by 1 percentage point or whether implied volatility decreases by 1 percentage point. The positive 208 is telling us that the price of this option will increase by $208 if IV goes up 1%, and it's telling us the price of the option will decrease by $208 if implied volatility goes down by 1 percentage point. $208 is a big factor, especially when you take a look at implied volatility. Implied volatility is shown by OptionView with this blue line that is part of the price and volatility chart. What this is telling us is that right now, implied volatility for all the gold options is right where this blue line intersects the blue vertical line that I just put in place, and it shows you the number in the lower right corner. IV is 21.1%. Just yesterday, it was 20.5%. The day before, it was 21.8%, and so on. You can see that it was as low as 18.5% on August 14th. So implied volatility on gold options fluctuates just like the price of the gold futures contract fluctuates. And this blue line is a composite reading of all of the strike prices, puts and calls averaged together. We're looking at a single option here that this 1385 happens to have an implied volatility of 19.6%. That's this particular option. And that 19.8% is a function of the price that it's trading at on the exchange, the strike price, $13.85. It expires in December in 78 days. And like everything else, the implied volatility of this particular option can fluctuate throughout the day as supply and demand for that particular option and for gold options in general changes. It all depends upon expectations of futures traders as to what's going to happen with the price of gold. You can see that today gold had a low of $13.81.90 and a high of $13.95. That's like about a $14 range. Right now we're kind of in the middle of the range at $13.87. So in this particular option, you can see what the low and the high price of the option has been today. There's open interest of 622 contracts, only 22 traded today. So the key here is when you are dealing in options, in this case a single option, your risk is now not just a function of market movement, price movement in the underlying, it's now a function of how long are you going to hold the trade and how sensitive is this trade to implied volatility. With the Vega factor at 255, the Vega factor of 255, that's telling us that this option price, which is $4,920 for this option, it can go up by $250 to like $5,175 if IV goes up by 1 percentage point. It can drop in price by $208 to approximately $4,710, 47.10 if the implied volatility drops by 1 percentage point. So as an options trader, you have to be very cognizant of what is happening with implied volatility. What do you think is going to happen to implied volatility, and how do you want to structure your options position to take advantage of your expectations? Basically, you have to have an outlook for not only the underlying asset in terms of movement up, down, or sideways, but you also have to have a forecast or an outlook for what implied volatility is going to do, and that will allow you to choose the proper type of a strategy that you want to employ. If you wanted to have a bearish position, but you did not want it to be this vulnerable to implied volatility, you could create a whole variety of other types of positions. You could create a spread where in addition to buying this put, you sell an out-of-the-money put, so now you have a debit put spread or a bear put spread. And look how that dramatically changes the Greek variables. Now the delta is only -8. The theta is almost less than $1, -25 cents a day. And the Vega is not 255, it's only +7. We've taken implied volatility out of the picture by creating a bear put spread. And notice this. The margin on this type of a position is only $1,100 as compared to $10,800 for a futures trader, or if you just buy the outright put, the margin is the cost, $4,930. So there are dramatic differences in your exposure, in the risk that you're taking, depending on how you structure your options position. This is a very low-risk position. That's why the margin is so small. It's also a position that will make money a lot slower than if you had a futures or if you had the outright put. But everything comes down to what type of a potential return can you make, not just in absolute dollars, but return on your margin. If you can make a $220 margin with the market dropping by $20 on the day you put this trade on, and if the margin's 1107, that turns out to be a 20% return on the day you put the trade on. If it takes 26 days for the market to drop, it still is a 21% return. And at 52 days, it still is 22% return. All of those are good returns, but they're all predicated on the market moving in the direction that you desire. However, you'll notice all of the Greek variables, the vega is very small, the theta is very small. This profit is a function of your delta. It's the Greek variable of delta that allowed you to make this profit. You were short in terms of delta, approximately 15 deltas short over this 20-point move to the downside. That's $2,000 for a futures trader. $2,000 times the delta of 15% turns out to be a $300 profit, ignoring negative time decay, ignoring any changes that may take place in implied volatility. It shows 240 on the screen, but the delta alone would tell you you'd expect to make about a $300 profit in 52 days with the market moving down $20. On one day, you'd make a $220 profit because your deltas in this one-day move were only 9 deltas short. So 9 deltas, 0.09 times a 20-point move down, a $2,000 move on the futures, is a $180 profit. This is showing 220 because it starts off with a $40 profit instead of a 0 over here. So what we're really looking at here is how you can use an options analytical program like OptionView to break down the profit or loss on a position by recognizing what portion of that profit or loss is a function of market movement based upon delta, what function is related to the passage of time, which may be against you or for you, depending on whether the data is positive or negative, and what portion is resulting because of any change in implied volatility. In this position, the changes in volatility will have a very small effect. Even with a big down move in the market in 52 days, you can see the vega factor is minus 22. So if we were to factor a volatility change of a 2% drop in implied volatility, and I put that in here, minus 2, what the program does is it takes that vega factor, multiplies it by 2, and adds it to the P&L line because you're getting the benefit of a decrease in IV when the vega factor is negative. So it's this type of analysis that as an options trader you can do with whatever type of a position you happen to have. And you really need to understand what type of an option spread do you want to construct based upon whether you want benefit from a rise in IV, whether you want benefit from a decline in IV, or whether you actually want to be insulated and you don't want to be affected by changes in implied volatility. Maybe you want to put on a position that's affected only by delta and only by theta. So it becomes very important to know what types of options trades, options spreads you can work with. Okay, so let me show you an example here of if you're bearish on gold, rather than doing an outright put purchase or doing a bear put spread, what if you were to do what's called a put ratio back spread, a put ratio back spread? That would be where you are going to be purchasing multiple out-of-the-money puts. In this case, if we buy 2 of the 1360 puts with a 36 delta, that would be 71 deltas that we're acquiring negative. And now if we sell a slightly in the money 1400 put against that with 50 deltas, the spread delta on this put ratio back spread is still negative. It's 21 deltas negative. The theta is negative by $31 a day, and the vega is positive by $239. So this spread is bearish, negative time decay benefiting from a rise in implied volatility. It has a completely different looking graphic analysis than the spreads that we looked at before. Here was the bear put spread with an $1,100 margin. Here was the outright purchase of the put with a $4,900 margin. Here's the futures contract with $10,800. And now here we are with a put ratio back spread with a margin that's close to $3,000, and its potential for making money looks good in the short run on the downside, but it looks horrible if time goes by, if 26 days go by. We won't even begin to make money unless the market drops below 1348. So you have to be obviously very bearish, and you have to have a strong opinion about implied volatility increasing as the market is moving down. Otherwise, you're not only going to lose from the passage of time, you're not going to get the benefit of the negative delta, you're also going to lose if implied volatility goes the wrong way. If implied volatility drops, you can lose a whole lot of money on this trade. And even if the trade were to move down by $20 on the day you put this on, and you look at the return on margin, the return on margin is 17% with a $20 move on the day you put the trade on. The profit is $500 with a $20 move. When we looked at our bear put spread, we had a $220 profit, less than $500, but the yield on that was 20%. So we actually have a larger yield with a lower margin trade with a $20 move on the same day because we structured the trade differently. And we took less risk if we were wrong, because our loss on the bear put spread was only, let's say, $210 if the market rallied by 30 bucks to the 1416 level. Whereas if we had our ratio put spread in place, we'd have a $520 loss, much bigger loss. So you want to work not simply with the Greeks, you want to work with the graphic analysis, and you want to coordinate the picture with the numbers. And OptionView provides a perfect vehicle for that, because you get to start off by putting the spread in the matrix. You can see what the Greeks are at the bottom of the screen. You click the Analyze button. You get a visual representation, a time-lapse view of how your spread can perform, both favorably and unfavorably, with the passage of time and with market movement. And it's really the pictures that you get used to, and you can in short order, you can really design the pictures to match what your expectations are, and then you really become an effective options trader. Everything comes down to potential returns on margin, potential losses, whether you have a plan in place to adjust or close your trades in the event the market is not cooperating and the losses are growing. You never want to have a position that will subject you to a huge loss with a small move in the market, and that would be the reason to keep your deltas at a reasonable level. That's the beauty of options. You can create spreads that have a delta that is much smaller than 100 deltas like a futures trader. But the smaller you make that net delta, the less vulnerable you will be to losses in the short run with an unfavorable move. And then it's just a matter of creating your exposure to Vega and your exposure to positive or negative time decay that makes you comfortable. I personally always create spreads with positive beta, because there are ways to do that, and there's no reason to create a spread with negative beta because if you do, it means that now time is your enemy. You have to be absolutely spot on with getting your position on at just the right time before a market move on a directional trade. Otherwise, time is going to end up causing you losses, just like this trade. So let's take a look, for example, at the trade that I would suggest if you were bearish on gold going forward and you wanted to benefit from a rise in implied volatility. Now, why do I say that? Why would I want to benefit from a rise in implied volatility on gold? Because when I look at this chart from option view, I can see a couple of things. This is a daily chart, a bar chart, along with the implied and statistical volatility overlaid on it. And we can also look at weekly bars. We can look at monthly bars. Well, looking at the big picture, looking at monthly bars, what this tells us is that we had a situation from 2009 to the middle of 2011 where implied volatility really dropped quite a bit. Then we had a spike up. We had another spike down between mid-2011 and 2013. And since then, we've had all of this year rising implied volatility. We've had rising implied volatility this year as gold has been dropping in price. That's the big picture. We can get sort of a look at the weeklies to get an idea as to what's happening. And we can also look at the dailies. Well, when I trade options spreads, most of the time I'm putting these spreads on with no more than a 1, 2, or 3 month trade horizon. I'm not working with long-term options. I'm working with options that are expiring in a relatively short period of time. And so this is telling me that when gold rallies, like it did here from June to the middle of June, we had a drop in implied volatility. When it then dropped for the next couple of weeks from the middle of June to the beginning of August, we had a little bit of a spike up in implied volatility. Now we've had a rise in the month of August. Implied volatility moved a little bit higher. Now gold is starting to move lower. Implied volatility is chopping around in a pretty narrow range. So it's a little bit erratic right now, but the big picture tells me that it is the decline in gold that leads to big spikes upwards in implied volatility. It's when gold has a big drop that IV tends to go up. Well, if I'm looking for gold to drop from here, I would also look for implied volatility to rally, to rise. So that means I want to put on a trade that has negative delta and positive vega. And as I told you before, I like to have positive theta as well. I don't want time to work against me. I want it to work for me. So if I'm bearish and I want IV to rise, there's 2 types of trades that I would look at. One of them would be an out-of-the-money calendar put spread. So for example, if I'm working with, let's say, November and December, an out-of-the-money calendar put spread would be using out-of-the-money puts, and it would be like selling the 1350 put, which is below the price of the futures at 1386, and I'd be purchasing the December, the same strike. That is an out-of-the-money calendar put spread. Now the delta is very, very small. It's only -2. The cost to put the trade on is the same as the margin. It's $1,100. It does earn positive time decay, and it has a positive vega. So this meets all of the criteria that I was looking for. If I'm planning on holding this trade for 33 days, you can see there's a very wide range of profitability here on the downside. And all of this profit is a function of the passage of time where the positive theta increases dramatically. The theta was $6.51 at an unchanged level. If we do have the passage of time, 33 days, even at an unchanged level, the theta has increased $20 a day. If the market drops down to 1356, the theta increases to $26 a day. And the profit on the spread would be $400 independent of implied volatility. If we also had the increase of implied volatility like I thought, when you put in a volatility change here in the upper left corner, it takes the Vega factor, which is positive, which is good for us, multiplies it by our anticipated 2 percentage point increase, and now the profits are not $400 at this level, but $550. And in relation to the cost of putting the trade on, the margin, that's an incredible yield of 49%. You can see this trade earns profits anywhere from $14.39 all the way on down, even below $12.96. That's a huge range of profitability, even if the market moves higher in price. So this would be one type of a trade that I would feel very comfortable putting on if I am modestly bearish on gold. It's a very low margin, has a great opportunity to make a good return on margin. I like the Greek variables. I like the way the graphic analysis looks. Another trade structure that would benefit from a bearish move with a rise in IV is what's called the diagonal calendar put spread. That's a diagonal calendar put spread is just like the calendar spread we looked at, except now instead of making the strikes in both months the same, I'm going to purchase in December a higher strike. Like I'll buy the 1375 slightly out of the money put in December, and I will sell an out of the money 1350 put in the month of November. That's a diagonal calendar put spread where my net delta is negative by 10, my theta is positive, almost $6 a day, and the Vega is positive as well. The margin on this is a little bit more, it's $2,200, but this is a trade where we can make a greater profit in 33 days than we can with the previous position because we have a larger negative delta starting out. This is the difference between the two graphs. We have upward sloping performance lines on the diagonal calendar put spread because we're starting off with slightly more negative deltas. And this will be a little bit more of an aggressive position. But the nice thing about it is if we're wrong and the market rallies on us, well, we still can make money in 33 days as long as it doesn't get above 1408. So the break even on the upside here is 1408. The break even on the upside with the other trade was 1439. So we have more room with the more conservative trade, but we have more profit potential in dollars with this trade. These are the two strategies that I would use as a go-to strategy for, as I say, a bearish outlook with an expected increase in implied volatility. Now, just to give you a full picture on this, what if you had a bearish outlook, but you expected that implied volatility was going to drop? It's not what I would expect, but let's say that that was what you were thinking. Well, there's another trade, a different trade structure that takes advantage of a negative outlook on the market with an expectation that IV will decline, and that would be an out-of-the-money put butterfly, an out-of-the-money put butterfly. So what's that? That would be like where you are purchasing, let's say in November, close to the money strike with puts. You sell a couple of the out-of-the-money puts. That's the body of the butterfly. So that's 40 points wide. Now we put on the other wing of the butterfly. That would be like 1310. This would be an out-of-the-money put butterfly where the deltas are slightly negative. The theta is positive. The Vega is negative. That's where I said this is a bearish position that benefits when implied volatility goes down. So here in 33 days, you can see what the profits are independent of implied volatility. And now if implied volatility goes down by 2 percentage points, look how big these profits can be. It's an extremely high return on margin to the tune of 45% at an unchanged level, over 100% in 33 days if the market drops down into this range here. And that's because this negative 2% takes the Vega factor, multiplies it by 2, and adds it to the profits and losses that we saw if we assumed an unchanged IV. Even with IV staying where it is, this is essentially 100% return on margin down at this level. So an out-of-the-money put butterfly is ideal if you are expecting a down move and you expect IV is going to drop. And now let's look at the other possibility. What if you were expecting a bear move in gold, but you really didn't even want to make any kind of a bet on implied volatility? You didn't want to be exposed to whether IV goes up or IV goes down. Well, there are a couple of strategies. I'll show you one that would benefit from that, and that's called a vertical call swap. A vertical call swap. That means we're going to go to, essentially, at least as a starting point, we'll go to a close to the money call option and we'll sell it. That's 52 deltas. We will go with an out of the money, let's say call option buy it. That's a credit call spread that is bearish. That's a credit call spread that's bearish. Here's what that trade looks like. You can do quite well with it as the market goes down. But you'll notice the margin on this trade is $2,830, and the losses can grow rather quickly if you're wrong and the market rallies. So to make this a lower margin, less risk trade, you simply go out into a deferred month and do exactly the opposite. You put on a bull call spread in the month of December to hedge this bear call spread in the month of November, and that gives you a slightly bearish position with positive time decay, very low margin, only $518, and a very low, almost non-existent Vega factor, so that in 33 days, when you look at how this trade can perform, you can see that the potential return on margin is very high, in the neighborhood of 44% at an unchanged level, 80-some% in 33 days, way down here. The picture really tells the story. The picture shows you how little exposure you have to big losses, even with an unfavorable move in the short run. So this is a very, very attractive trade structure when you want to remove the Vega sensitivity on your position, but still benefit from direction, still benefit from positive time decay. It's a vertical call swap. So let's close this. And we were looking at bearish alternatives. Let's look at a different market entirely. We were looking at gold, which is a $138,700 market. What if you're interested in trading the stocks? Well, look at this. E-mini S&P is priced at 1670.25. Well, what does that mean? If we go to the matrix, if we click the define button, and we go to futures, this E-mini S&P has a contract multiplier of $50. So if you take the price, 1670 on the September contract, 1670, multiply that by 50, $50 a point, that comes out to be $83,500. That is the underlying contract value for an E-mini S&P electronically traded futures contract. The gold one was $138,000, so this is a smaller contract. So right away, that should tell you that this is, in some respects, a less risky asset to construct options trades with. It's less risky because it's a smaller contract. And when you put on a spread that has a delta of, let's say, 10 deltas, 10 deltas times a contract value of $83,500, 500 is like an asset of $8,350. That's really what you are dealing in. You're dealing in price changes on an $8,300 contract for all intents and purposes. When you put on a 10 delta trade in gold, 10% of the underlying contract value of $138,000, that's a $13,800 contract. Quite a bit different. That's the way to really think about these things. So let's take a look. Contrary to what most people would logically think, here we're talking about possibly going to war with Syria. The stock market is on a strong move to the upside. And as the market is moving up, implied volatility is coming down. If you wanted to play for a continuation of this move, a rally in the markets accompanied by declining implied volatility, what's a good strategy for that? A rally with declining implied volatility. Well, there's a couple of strategies. An at-the-money not an at-the-money, but an out-of-the-money call butterfly. An out-of-the-money call butterfly. So let's take a look. We've got October options with 40 days to go with the market at 1663 right now. If we were to buy the 1650 call, if we were to sell a couple of the 1700 calls, that's 50 points wide. Now we can go to maybe the 1750 call, buy that. So we bought the wings, sold the body at 1700. This position is definitely biased to make money on the upside with the passage of time. And if we look at 27 days, essentially 4 weeks, here's how this trade could perform. And if we're right about implied volatility coming down as the market drops, take a look at what these profits could be on the upside. They're very attractive in here. With the margin only $900, returns can be quite attractive here. So we are controlling an $83,500 asset with this spread by only having to put up $900 margin and potentially being able to earn 50-some% or more return on our margin in a 27-day period if we are right about the market continuing to move higher and we are right about implied volatility declining a little bit. If implied volatility didn't even decline, we still have a good profit on this position. So really what it comes down to is understanding what trade structure with options makes sense given your directional outlook on the futures and given your anticipated change in implied volatility. And then creating the trade so that you can put into place an exit strategy and you can put into place a get-out strategy or an adjustment strategy if the market moves unfavorably, in this case to the downside. You can see the market could drop 30 big points right away and you're still going to have a very small loss on this trade, very small loss, because even the Vega factor is very small. So it's all a matter of deltas on the move down that causes a loss, which is small. Plenty of opportunity to make a change or to exit your trade. So that would be one trade strategy for a bullish position in the E-minis with implied volatility going down. You could also do what's called a reverse diagonal calendar put spread. Reverse diagonal calendar put spread. Well, reverse diagonal means we're going to buy the front month, sell the deferred month. And since it's with puts, if we were to purchase the, let's say, 1650 put, let's do this differently. Let's say, purchase the 1650 put, And if we were to sell the, let's go out to the 1600 put. This is 13 deltas negative. Now this trade does have negative time decay, and it does have a negative Vega factor, but it is rather small. And you can see that you do need a rather large down move with the passage of time. In 27 days, you need the market to go below 1637. And you know what? I'm doing this completely backwards. We wanted to have a bullishly oriented trade with not bearishly oriented trade. So I did that backwards. The bullishly oriented trade would be still a reverse diagonal put spread where we are purchasing in the front month the out of the money put. We are selling in the deferred month a closer to the money. So now we get our positive deltas with our negative Vega. That's what we want. We want to be able to benefit with a decline in implied volatility, a negative Vega factor as the market moves higher. So here's where you can get a very nice yield in the neighborhood of, well, 17% at an unchanged level, in the neighborhood of 50% to 60, 70% at higher levels here. So that trade structure is also appropriate for a bullish position with a drop in implied volatility. What I've really done is I've identified with a template 2 types of options strategies for every conceivable market environment. In other words, if you're bullish and you expect IV is going to go up, I've got 2 trades. If you're bullish and you expect IV is going to go down, I have 2 trade structures for that. If you're bullish and you don't want to be exposed to implied volatility, I've got 2 trade structures for that. Same thing for bearish positions, same thing for neutral positions. So what I'm really discussing here is virtually a template that has 9 different market scenarios, and within each of those 9 scenarios there are 2 options strategies that you can choose from when creating your position. And this template is essentially what I have created in my ACE program CD. It's what I call my Encyclopedia of Options Strategies CD. And if you're interested in finding out more about that, what you can do is go to my website, I'll put it in the chat window so that you can see what it is. It's www.theaceprogram.com, and you can take a look at the ACE CD. Oh yes, one of the individuals had asked here if this webinar will be archived for viewing. Yes, it is. It will be archived by Option View right on the main page. You can go to Archive Webinars and you'll be able to review this webinar again. All right, let's see here. So, you know, this process I'm describing to you is really where the rubber meets the road. As a trader, you really need to have at your disposal the tools that are going to help you act decisively and act effectively. And that's really why you need to have in your arsenal exactly the strategy types that match your outlook and your expectations for a market. And that's what will allow you to easily go into a program like Option View, create the type of trade that will provide the profits that you're looking for once your expectations are laid out. And you can tweak these positions by changing the strike prices, trying to modify your deltas to be more or less negative or positive depending on what you're really attempting to accomplish. You can use the information here about open interest to make sure that you're structuring your trades with options that have adequate open interest so that the bids and the offers will allow you to not incur a significant amount of slippage. So everything, in my opinion, that you learn about options really comes down to creating the type of a spread that is going to allow you to earn a high return on margin without excessive risk and without large margin requirements. And that's really where OptionView also shines, because you can see by changing some of your strike prices and changing your net delta exposure, how your margin will be affected. Obviously, the higher your positive or negative deltas, the greater the margin will be. The closer to neutral you will be on your net delta, the lower the margin will tend to be. The less your vega exposure, the lower the margin will be. It's all common sense because everything comes down to risk. There's 3 dimensions of risk: price movement up or down, changes in implied volatility, and positive or negative time decay. And to the extent you keep those variables small, you will have low margins and you will have the ability to earn reasonable returns on margin. Okay, well, I don't see any other questions at this point. Is there any other markets that one of you would like me to review and put together a spread for? I've only looked at gold and the E-mini. There's many other markets here we could look at. We've got bonds and 10-year notes. That's sort of an interesting, 10-year notes is a very interesting market because that really is a market that has seen a very long term, over the last 5 months, downtrend in price, which means long-term 10-year interest rates have been increasing. And we are just starting to get a little bit of move to the upside here in the last couple of days after there was a sharp move down near the end of last week. So 10-year notes are a very interesting market to trade because look at what the blue implied volatility line has done. It's right near the high end of the range. And even when you look at the weekly or the monthly, look at how high we've seen implied volatility move. It was way down only 3.4% at the end of April. Now it is up to 7.5% right now. As bond or as notes futures are declining in price, implied volatility is increasing. So there's all kinds of interesting spreads you can do in the 10-year note market to take advantage of both a directional outlook as well as an implied volatility outlook. All right, well, once again, I would encourage all of you to listen to the archived webinar, which will be posted probably later today or tomorrow, and take a look at my website, theaceprogram.com. I have other educational resources there, but the ACD is certainly the one that would apply to the template that we're talking about here. Thank you all very much.